and hello everyone. Today we learn about the dynamics of the cash flow statements. To understanding where your money comes from and where it goes, the key to financial health and strategic decision making. What is the cash flow statement? By definition, the cash flow statement tracks the actual movement of cash into and out of a business over a given period. Unlike the income statement, it ignores accruals and focuses solely on a real cash transactions. This is the core formula. Cash flow equals cash inflows minus cash outflows. The three PR of cash flow: operating activities, investment activities, and financing activities. When and why to use it? If you evaluate the ability to pay short-term bills on a time, check if net income is supported by actual cost reserves, fund future growth and expansion internally, detect potential financial distress and risk early. This is a key use cases: assessing liquidity, evaluating profitability quality, planning investment, detecting financial distress. Theoretical example: step-by-step calculation. Let's calculate the net cash flow for a fictional company, Sunrise Corp, for the fiscal year 2024. Calculation: operating, investment, financing. If we calculate the net cash flow, we gain 10,000 euro on a years. That means Sunrise Corp and the years with a positive net cash flow. This is a visualizing the cash flow results. The waterfall charts show how each activity contributes to the final cash flow positions. Despite heavy investment spending, strong operating performance and financing inflow result in a net increase of 10,000 euro over the opening balance. Let's take a real-life example: a local Café. What is the situation? Mary runs a cafe. Her income statement shows a profit of 8,000 euro, but she struggled to pay supplier. Why? Her cash flow statement reveals the truth. What is the revelation? Customers pay on 60-day credit term. Cash inflow are delayed, while supplier payments are immediate. Profit different by cash. The cash flow statement exposes this timing gap. What the solution? Marie renegotiates payment terms, introduces upfront deposits, and builds a cash reserve. All decision guided by her cash flow analysis. What is the difference between profit and cash flow? This is the critical difference. In the graph, we see the profit in a green and the cash flow in a red bar. The key insights. A company can be profitable on a paper yet run out of cash. The chart above illustrates how profit and cash flow can diverge significantly quarter to quarter. Remember, profit is an accounting concept. Cash is a reality. You cannot pay bill with a profit, only with a cash. What is the expert advice? How to get the most out of it? Review it monthly. Focus on operating cash flow first. Build a 13-week cash flow forecast. Let's resume and take a key takeaway. What is the definition? Track a real cash movement. Inflow minus outflow across three activities type. Purpose. Assess liquidity, verify profit quality, and detect financial stress early. Calculation, operating plus investment plus financing equal net cash flow for the period. What is the expert advice? Review monthly, prioritize operating cash flow, and always forecast ahead. That is our lesson for today. Thank you very much. If you have a question, don't hesitate to write in the comment. Click the bell to have a notification for our news video. See you soon.